Okay, let's dive right into this explainer and tackle what is literally the ultimate analyst dilemma. How exactly do we calculate the intrinsic value of a hypergrowth space company using just raw financial data? Today, we're putting on our sell-side equity analyst hats to conduct a rigorous fundamental valuation audit of Intuitive Machines. That's ticker symbol LUNR. We're going to rely strictly on the financial metrics provided in our source documents to see if the actual fundamentals can justify the current wild market narrative.
So we're approaching this like a detective's audit. Here's the game plan. 1. The financial baseline. 2. Absolute valuation models. 3. Sum of the parts limitations. 4. Relative valuation and peers. 5. Our asset-based breakdown. And finally, 6. The final intrinsic value.
All right, Section 1, the financial baseline. Before we even attempt to model out the future, we have to establish the stark reality of exactly where Intuitive Machines stands in the market today.
And, well, this number right here is just staggering, 610.76%. That represents LUNR's phenomenal return in 2024 alone. This massive market enthusiasm has driven its current market cap up to roughly $5.186 billion, with the stock recently closing around $24.11. The market is clearly incredibly optimistic about the commercialization of space and LUNR's position right in the middle of it.
But here's the central tension we've got to resolve today. Despite that explosive price growth, the company's trailing free cash flow sits at a deeply negative $56 million. So we've got a classic frontier tech paradox on our hands. The stock price implies absolute perfection in future execution, while the current cash flow statement shows a heavy, ongoing cash burn.
Let's move into Section 2, Absolute Valuation Models. Let's see if we can logically model those future cash flows and somehow bridge the gap between this current burn and that future promise.
Normally, to build a discounted cash flow, or DCF model, we need specific forward guidance, projected capital expenditures, and a defined weighted average cost of capital. But because our source data lacks these specific forward projections, as analysts, we have to supplement with sensible defaults. To even attempt a DCF here, we're assuming a standard high-risk discount rate of about 12% to account for the massive execution risk of, lunar logistics, along with a long-term terminal growth rate of about 3%.
This really illustrates the DCF dilemma perfectly. We've got a trailing 12-month revenue of $210 million, which is great. That shows real, tangible top-line generation. But the net profit margin is a devastating negative 92.77%. Forecasting a bridge from this intense current cash burn to positive, stable, unlevered free cash flows means we have to assume massive, sustained margin expansions over the next 5 to 10 years. Plus, we have to assume ongoing capital injections, because that negative $56 million in free cash flow means these operations absolutely aren't funding themselves yet.
Now for our next absolute model, the dividend discount model. Yeah, we can immediately bypass this one. The source data explicitly states LUNR has a 0% dividend CAGR. That means they return literally zero cash to shareholders right now. And honestly, for a high-growth aerospace startup that's aggressively reinvesting every single penny it can find, applying a multi-stage DDM would be totally inappropriate anyway. Similarly, we run into some major structural roadblocks with the residual income and adjusted present value models. LUNR has a negative price-to-book ratio of negative 3.91 and a deeply negative return on invested capital of negative 6.04%. Listen, when your starting book value of equity is negative, residual income models simply break down. Furthermore, an APV model, which separates the value of operations from the tax shields of debt, is incredibly noisy here. Why? Because the future debt levels of a space startup that currently shows a negative debt-to-equity ratio of negative 0.45 are just highly, highly unpredictable.
Okay, Section 3, Sum of the Parts Limitations. What if we try to break the company down into its individual pieces? Like maybe their lunar lander division is masking the profitability of a completely distinct data services arm.
Well, to be rigorous here, we have to explicitly state a limitation. Our provided source material simply does not contain distinct business segment data. We don't have separate revenue, margin, or risk profiles for different divisions. So we actually can't perform a sum of the parts valuation today. We're forced to treat LUNR as a single, consolidated entity based on the data we have at hand.
So the crucial point here is this. When absolute models require just way too much guesswork and multi-stage margin assumptions to be reliable, we have to look outward. We have to ask, how is the broader market pricing this exact type of risk?
Which brings us nicely to Section 4, Relative Valuation and Peers.
Let's compare LUNR's multiples against the broader industry to see if its pricing aligns with reality.
Now, the source documents don't actually list specific competitors by name, so to conduct a relative valuation, we have to rely on an external assumption. We're going to group LUNR with a basket of publicly traded space, defense, and frontier technology peers to find comparable medians. Basically, we're looking for other capital-intensive, high R&D hardware companies.
Let's look at the multiples and see how this builds out, because this data is incredibly revealing. An EV to sales ratio of 23.51 is, frankly, astronomical. For context, mature defense or tech hardware companies often trade closer to 2 to 5 times sales. And that forward PE of over 3,300? Combine that with a trailing EV to EBITDA of -59, and it shows the market is entirely ignoring current operating losses. The market is pricing in almost perfect future execution and total LUNR market dominance compared to our assumed peer group. The premium here is absolutely massive.
All right, Section 5, Asset-Based Valuation Breakdown. If the future is priced for perfection, let's ground ourselves back in physical reality. What are the company's assets actually worth today?
Using the clues provided in the source metrics, we can piece together the balance sheet's health. We actually see surprisingly strong short-term liquidity, with both a current ratio and a quick ratio sitting at 4.96. That means they have the liquid assets to cover their near-term obligations right now, which is great. But the EV to assets ratio of 6.52 tells a totally different story regarding valuation. It means the market's assigned enterprise value heavily outpaces the actual physical assets sitting on the books. To estimate a liquidation value, or net asset value, we'd systematically calculate the book assets, subtract liabilities, and divide by shares. But here is the analyst's reality check for you. Space hardware is highly specialized. If LUNR had to liquidate, a lunar lander prototype doesn't exactly sell for full price on the open market, right? We'd have to apply a severe fire sale discount. Given the negative equity and the highly bespoke nature of their tech, the net asset value provides a floor that is radically lower than the current $24 share price. The stock's value is entirely wrapped up in its future earning power, not its current physical assets.
Now, let's pull all of this together for Section 6, Final Intrinsic Value, and deliver our comprehensive verdict on LUNR.
Our final synthesis shows a massive, cavernous spread in implied value. Asset-based models imply a steep discount, practically valuing the company at just a tiny fraction of its current market cap. The DCF model requires exceptionally heavy, optimistic margin growth assumptions just to justify the current price. And our relative valuation proves LUNR is trading at a massive premium compared to practically any traditional metric out there.
And honestly, this brilliantly illustrates why our source data literally lists the DCF fair value price and the margin of safety as exactly this, NA, not applicable. It's a striking admission from the raw data itself. The current fundamentals, the heavy cash burn, the negative ROIC, the astronomical multiples, they are completely divorced from the speculative trading momentum that drove a 610% return in a single year.
Which leaves us with this final, provocative thought as we wrap up this explainer. When valuing the absolute bleeding edge of the frontier, like commercial space exploration, do traditional financial models even apply? Are we actually analyzing a business based on its trailing metrics, or are we simply trying to price the dream of a lunar economy? I'm going to leave you to ponder that one. Thanks for joining me on this valuation audit.